joined today by Dr. Robert Bauer, Chief Global Economist at the Principal Financial Group. Dr. Bauer, thank you very much for speaking with us here at CNBC TV 18. Let me start first by asking you for your prognosis of where the global economy stands today.
I think the prognosis is generally pretty good, but the world is rebalancing. You know, we had 10 or 15 years of a tremendous economic boom driven by China, huge investment growth in China, which really pulled all the rest of the emerging world along with it. Profits were terrific. Demand growth was fantastic. Stock market outperformance was wonderful. And at the same time, the developed countries, the U.S. and Europe went through financial crises, both. But now I think that's changing, and the world in some sense is rebalancing. China is slowing. It's clear that its investment boom is fading somewhat. Growth is slowing in emerging markets as well as China, but we see growth picking up across the developed world. We think the U.S. is in a moderate recovery. I believe Europe is at least a modest recovery, and I think Japan's economy is probably doing better than the most recent GDP figures would indicate.
Amongst the headwinds, if I may add now, the raised specter of geopolitics on the back of what we've seen take place in Paris. What would you say that would mean for global growth here on?
Well, certainly it's a headwind. What's happened in Paris and other places, it's just a real human tragedy, and it's so horribly unfortunate. From a political standpoint, I think what it's doing is driving a wedge a little bit among the countries in Europe, because they've had free travel across Europe, free exchange of goods and services, and now with a huge influx of refugees from the enormous conflicts in the Middle East, that's going to be a problem for unity within the European Union and the Eurozone in particular, as some countries are willing to accept refugees, other countries have questions about their ability to do that and how much risk they take by bringing along with refugees some people that want to just inspire even more terrorism.
And how much do you think that will in a sense cause the disintegration of unity in Europe? For instance, there is now talk about a reconsideration of the Schengen visa area.
Well, it's certainly true. As I said, I think it's driving a wedge between countries. I think disintegration is too strong a term, but it's certainly meaning that there's different incentives in different countries to get along, and some countries are willing to accept refugees and others are not. So it is a headwind for growth in Europe. I think ultimately things will be okay, but one doesn't know with this kind of terrorism.
Well, in the last few years, we've often speculated on whether, at a point when we thought Greece may exit the Eurozone, whether it will mean a collapse of the Euro in that sense. We're now talking about disunity, if not disintegration, within the European Union area. I'm just curious to know where you think this is going to end.
Well, I'm not sure we know. It's going to depend on future events. Up until now, I've been pretty optimistic about the European Union being able to maintain the union and the unity. The unity came from a political framework, in fact, over a long period of time, really centuries of wars across Europe. And after the second huge conflagration of the 20th century, countries got together and said, this has just got to stop. And it all began with the European coal and steel community in the early 1950s, where 6 countries got together and formed a kind of free market among coal and steel. Every few years, a few more countries, a few more commodities, and it ultimately developed into a monetary and currency union, which I think was hugely helpful for the country. It cut costs of trading among goods. It made travel very easy across across countries, and the political unity behind that and the political fervor to keep that going, I thought the Union would stay together, and the European Central Bank certainly helped further that. This is a headwind of a completely different kind, and I think it's too soon to tell exactly how much of a headwind this will be, but it certainly is a big headwind.
Do you think that this will firm up Mario Draghi's intention to offer more easing to help the European economy?
Well, in some sense, he's almost promised to do something already by a couple of statements, and I think the market is expecting something. So probably the least he could do at the next meeting is to extend the time for which he's buying the 60 billion euros of bonds per month, extend it maybe to the end of 2016. That's probably the minimum of what he could do. But given the headwinds from the tragedy in Paris and the refugee crisis that's taking place, it's possible he could do more to try to make the incipient recovery that is indeed going on in Europe, to help it along and continue it for a while longer.
And what could that more entail?
Well, he could certainly increase the number of bonds that he's buying. He could above $60 billion, as well as extend the time. He could also purchase corporate bonds, for example, and extend that. He could make loans even easier for corporates or for banks to relend. So I think there's a fair amount of other things that he could do. He's done an awful lot already, and I think the Eurozone recovery is coming along pretty well. We think the Eurozone could grow 1.5%, maybe even possibly 2% this year, although the upper range there is now in question with what's going on. But the recovery is getting established, and I think the president of the ECB has done a good job in helping foster that recovery.
If he was to do more than anticipated in the wake of the Paris attacks, what impact do you think that's going to have on the possibility of a Fed rate hike, which now, after the minutes that were released yesterday, many people believe is a sure shot in December?
Well, we agree with that. It would be hard, I think, for the Fed to not raise rates in December with all of the preparatory talks and speeches and minutes and statements that have gone on right now. I think the Fed is going to raise rates really regardless of what the European Central Bank does. The Fed has to look at the last payroll report, which showed wages now growing 2.5% a year. That's the highest in 6 years. So I think the labor market is likely tighter than people at the Federal Reserve believe, and I think it's just time for a rate hike. So even if President Draghi does ease conditions, like he will likely do something at the next meeting, I don't believe that would deter the Fed from another rate hike, or from their first rate hike.
Why do you believe, or why do you think that a more expensive dollar, if there is more action out of the ECB than anticipated, a more expensive dollar will not discourage the Fed from moving in December?
Well, if you look at what's happened to the dollar over the last 18 months, it's up dramatically already. So the dollar has already tightened policy, and I think a lot of that move, as well as the more recent decline in the euro from about 115 to now, 106.5, something like that, I think a lot of that move has already been in anticipation of what the Fed is going to do, and in anticipation of some easing measures that Draghi has already essentially said he would do, and I think in some sense promised at least something. So I think the markets are already anticipating that, so I think the idea that the dollar is going to continue to strengthen is not necessarily going to come to pass.
Do you believe that if the Fed does in fact move on rates in December, that we'll see a big impact in both the U.S. bond markets as well as the U.S. equity markets? So do you believe that the markets have by now already factored in the impact of that first initial rate hike?
Well, I think if you look at what happened last night at the U.S., we saw the dollar weaken just a little bit. We saw a huge rally in the stock market. That's after the minutes came out. The minutes pretty well, the minutes of the last Fed meeting pretty well agreed with, I think, what the markets expect. Most people do expect a rate hike. And I think, frankly, a rate hike would be viewed very positively because it would be the Fed saying, yes, I think the U.S. economy is indeed strong enough that we can handle the beginning of a tightening of monetary policy. So for me, a rate hike would be a piece of confidence by the Fed telling the rest of the world and the investors and consumers in the U.S. that the U.S. economy is in pretty good shape. I think that would be positive for markets.
So you think that the markets have either already factored in or that they will not react poorly to a rate hike decision if it were to come in December? What about the collateral impact on emerging markets? Fund flows is something that we're very worried here about in India. Can you give us a sense of how you expect fund flows to react to a December rate hike?
You know, because I think there's been so much of this reflected in the markets, I think the negative part of those fund flows may already have happened. You know, we've seen stock markets in the developing world come under extreme pressure. We've seen currency markets plunge all across the developing world. So I think the anticipation of the Fed move has already made some of those things happen. And if the Fed now shows some confidence in the U.S. economy that it is indeed strong enough to take a small rate hike, then I think that's a positive thing for the rest of the world, too. Because a strong dollar, which is what we've seen over the last 18 months or so, is a way to redistribute growth from a strong United States to the rest of the world. So a stronger dollar means households and businesses can more easily buy goods from around the world, which then helps economic growth around the world. So, in fact, I think that might be a positive, and we might see, in fact, some of those concerns about outflows from emerging markets maybe not be correct.